In this video, we will discuss an overview of stock market history and performance with a focus on the United States stock market and some comparison to other countries. My name is Kirby Cundiff. I have a Ph.D. I'm a chartered financial analyst and a certified financial planner. I'm currently the chair of accounting and financial management for University of Maryland University College. In this graph, we look at the performance of the Dow Jones Industrial Average from 1900 until close to today. The Dow Jones is an average of around 30 different stocks. It is not market weighted, so it is not as accurate as some of the later stock market averages. Originally, the Wall Street Journal was just a listing of the price of these stocks, and the Dow Jones average was the sum of them together. This is a log graph, so you can see that we blew up the earlier time periods over the later time periods. This large peak here is the peak in 1929 before the huge market crash from 29 to 33 of around 90% that was followed by the Great Depression. You can see throughout the Dow's history there have been consolidation periods followed by market run-ups like the one we see from 1915 to 1932. This run-up was probably associated with the huge tax cuts by the Coolidge administration, and also the Federal Reserve was created in 1913 and printed far more money than it had gold to back it. The Fed cut down on these policies in the late 20s, was no longer printing so much money to help out the British and stabilize the gold exchange rate between the two countries, and possibly that led to the stock market crash. The next consolidation period occurred from 32 to 49, followed then by a huge market run-up after World War II. There was again a default on the gold standard under the Nixon administration, and throughout the 70s there was an effort to get inflation under control, since once again the Fed had printed more money than it had gold to back it. That is associated with this consolidation period shown from 1966 to 1983. We can see during that time period when the Fed increased interest rates, the market dropped by up to 40%. The Fed would then cut interest rates, the market would go back up. They increased interest rates, it would go back down. And this cycle continued until after Paul Volcker was appointed to the Fed in 1979. He massively increased interest rates, again causing a recession, but he was able to stabilize inflation. After that time period, the Fed eased off, and the greatest bull market in U.S. history occurred from 1983 to 2000. That was then followed by this consolidation phase. First, the bursting of the dot-com bubble, then another run-up, and then the bursting of the housing crisis. The Dow Jones Industrial Average is only one type of index, and it only covers around 30 stocks, and it is not market weighted. Market weighting meaning the bigger stocks have a greater weighting in the index. Individuals can invest in the Dow by investing in the so-called Diamonds, DIA, which is a type of exchange-traded fund, basically a package of a bunch of the different mutual funds invested together. A broader package, the Spiders, SPY, would track the S&P 500 and includes the 500 largest stocks in the United States. A very diversified package, the VTI, the Vanguard Total Stock Market Index, tracks the Wilshire 5000, which is supposed to be the entire United States market, and covers 3,500 stocks approximately. You can also invest in the QQQ, which covers the tech stocks, the NASDAQ 100, or if you want emerging market indexes, VWO, are the extremely broad worldwide market weighted VT Total World Index. These indices that begin with a V are those issued by Vanguard, which is one of my favorite mutual fund companies. These are all examples of ETFs, or exchange-traded funds. They are also closed-end mutual funds. meaning the stocks are packaged together and then sold and retraded, as opposed to an open-ended mutual fund in which the mutual fund manager trades the stocks all the time and can always issue more shares. These are all examples of market packages of stocks. You can also invest in individual stocks, but for most investors, this is a lot more risky. You can get quotes for these stocks by going to sites such as vanguard.yahoo.com or bloomberg.com. This graph shows the performance of various asset classes from 1800 until today. You can see by far the best asset class to invest in. $1 goes to close to $1 million, and this is corrected for inflation in stocks. It's also worth noting small stocks have tended to outperform large stocks, although this wasn't or isn't as much the case since it was noted. Once everybody knows an investment is good, they tend to rush into it. The next best investment has been bonds and bills, but note that was only in the early parts of the United States. Since the Federal Reserve was created in 1913, most of the rate of return of bonds and pretty much all the rate of return of bills has been eliminated by inflation. This is due to the fact that as the Fed has printed money, it has decreased the value of the dollar by now over 95%. Gold has largely been a hedge for inflation, and of course, before the Fed defaulted on the gold standard, gold and the dollar tracked very closely. Bills now, again, only perform about the same as gold, or perhaps even worse. While individuals can invest in stocks, it is reasonably highly risky. The S&P 500, if we look at an average stock in it, it has an annual volatility of 25% or standard deviation. Other types of stocks, energy stocks and pharmaceutical stocks, perform far worse. As we add more and more of each class of stock, the risk tends to go down. For the S&P 500, that risk goes from around 25% to down here of maybe 17%. If we're in an even more diversified ETF like the Wilshire 5000, or perhaps also investing in foreign stocks, then you can get this annual volatility below 15%. This is the idea of don't put all of your eggs in one basket. There is, of course, the alternative view, to quote Andrew Carnegie, put all your eggs in one basket and watch the basket very closely. That tends to work very well for people who at least have been successful in investing in their own businesses like Bill Gates, but the average person is not able to do this, and of course this looks more at passive investments, and even investing in your own business. Some people do very well at it, but many businesses do fail. It is also very difficult to pick a sector to invest in. This table shows the performance of different sectors from 1999 till 2013, and it can show, well, a sector will do very well in one year, then it might do very poorly in the next year. For example, technology stocks went up by around 65% in 1999, but then the dot-com bubble bursts, and the next 3 years they performed the worst at negative 42%, negative 23%, and negative 38%. It is very difficult to pick a sector that performs very well every year. Note the S&P 500 is largely in the middle in most of these years, since of course it is an average of all of these sectors. Most individual investors are also better with index funds than with actively managed funds, the open-ended mutual funds I mentioned. The reason for this is an active managed fund. The fund manager trades quite frequently. This creates capital gains taxes. It also creates trading fees, and the active manager has to get paid. An index fund has a management fee typically of around 0.2%. An actively managed fund has a management fee of 1 to 2%. So the active manager has to be smart enough to outperform the market every year by around 1% just to pay his salary. The Wall Street Journal has commonly done an example of how this doesn't work, getting active managers each year to pick stocks and then comparing their performance to proxies such as throwing darts at a board, pecking chickens, or second graders. In about 50% of the time, the active managers outperform the second graders. In around 50% of the time, the second graders outperform the active managers. This doesn't mean the active managers aren't very skilled, highly knowledgeable people, but there are so many of them following stocks, even though they have CFAs, MBAs, PhDs in math or physics, the odds of one finding things the others don't is pretty difficult. So note, passive management outperforms active management in over 50% of the time in a one-year period, and over longer periods, like a 10-year period, over 80% of the time. So in 80% of cases, you are better off with an index fund, for example, the total market index fund with Vanguard, than you are with an actively managed fund. This graph shows the Shiller price-to-earnings ratio. A price-to-earnings ratio is a measurement of market valuation. It is the price you pay for an asset over the earnings of that asset. So the inverse of it, or E over P, is like the percent rate of return of interest on a bank account. The higher the P/E ratio is, the more you are paying per dollar of earnings. The Shiller P/E attempts to average out recessions and bad time periods by, rather than having a yearly earnings, it has a 10-year earnings. Note on this measurement, our current time period, stocks are very highly valued. The only time they were more highly valued was during the dot-com bubble, and they are about as valued today as they were before the stock market crash of 1929 that preceded the Great Depression. So on this measurement, this could be a very bad time to invest. Other measurements that look at forward earnings don't look nearly as bad, but perhaps this is an indication for some caution. Another way of valuing stocks over time is the Fed model. The idea behind the Fed model is an individual has a choice between investing in government bonds or the stock market. Government bonds would typically be less risky. Stocks could go bankrupt, lose money. The government can always just print more money to pay its debt. So if we look at the earnings yield, E over P, versus the 10-year bond, if 10-year bonds tend to go up, or the 10-year bond yield tends to go up, then stocks will tend to go down, as we saw in the 70s. And we can see from the 50s up until when Paul Volcker took over at the Fed, the 10-year Treasury yield went up and down, but it tended to go up. The earnings yield on the stock market went up and down, but it tended to go up, and stocks did not do well in the 70s. After inflation was under control and the earnings yield dropped, we had the biggest stock market in U.S. history from 82 again to 2000. And the stock market ran up tremendously. If, of course, inflation starts to pick up again and the 10-year earnings yields tends to go up, that would tend to be rather bearish for stocks, as individual investors would move out of relatively risky stocks and into potentially riskless treasury bonds. Again, the federal government can print money. It can always pay its debt because its debt is issued in dollars. And this is different than a country like Greece, which debt is issued in euros, and the government cannot print euros. Only the European Central Bank can print euros. Another example of how governments influence stocks is Austrian business cycle theory, which is opposed to Keynesian economics. The idea of Keynesian economics is the Fed can move interest rates up and down to mitigate business cycles. The Austrian business cycle theory would indicate that the Fed moving interest rates up and down, in fact, causes business cycles. And this was developed by Ludwig von Mises and Nobel laureate Friedrich Hayek, who debated regularly with John Maynard Keynes, the other Nobel laureate. We can see once again, now we are looking at short-term interest rates, the Fed funds rate or the overnight lending rate, which increased during the time period from 55 to 82. The government defaulted domestically on the Bretton Woods Agreement on the gold standard in the early 70s. It raised interest rates to attempt to fight inflation, which caused the stock market to drop. Then it lowered them, the stock market went up. Then it raised them, the stock market went down. This also affected other things in the real economy. Again, the stock market was very bullish from 82 to 2000, but the raising of interest rates here caused so-called duration mismatch. Normally, a bank or savings and loan makes money by borrowing short-term and lending long-term. The yield curve was inverted during this time period, and banks were therefore forced to borrow at a higher interest rate than they lent at. This caused many of the savings and loans to go bankrupt in the early 90s, which is discussed in another video. Also, later on, as interest rates dropped here, we had a huge stock market run up, particularly in the tech industry. Then the small raising of interest rates here was associated with the bursting of the dot-com bubble and the following stock market crash from 2000 to 2003. The Fed then again lowered interest rates, now down to around 1%. Whenever you print money, it goes somewhere, but it's not always easy to tell where. In this case, people decided to borrow at very low interest rates and buy houses, leading to the housing bubble. Of course, if you have a variable rate mortgage and you're borrowing at 1 or 2%, and the Fed funds rate then goes up to 5%, as we show here around 2007, well, many people's home mortgages went up from a few $100s a month to $1,000 a month, which they were not able to pay. Therefore, they defaulted on their houses, collateralized mortgage obligations went bankrupt, and again, we had another set of bankruptcies, in this case associated with the default of the mortgages and a huge bailout. After that, once again, the Federal Reserve lowered interest rates down to 0%, and they're just starting to raise them now. The Fed funds rate is a short-term interest rate, so they lower the short-term interest rates to 0%. They also did something they had never done before. They started interfering in the longer-term interest rates on the yield curve, which is called quantitative easing. So again, before the time period of around 2009, the Fed only controlled short-term interest rates, overnight lending rate, maybe one-year T-bills. During quantitative easing, they started buying long-term debt, 30-year bonds, 20-year bonds, and even home mortgages, pushing down all of these interest rates. Again, if the Fed prints money, it has to go somewhere. Of course, the market responded by this. The market had been dropping until, as we can see here, around 2009. When QE was announced, lots of money was injected in the system. The market stabilized and then tended to rally as the government was buying all this debt. When QE1, the end of it, was announced, then the market pulled back again. QE2 was announced, the market rallied again. QE2 ends, the market pulls back again. Operation Twist, another form of printing, and then QE3 is announced, and the market rallies again. This sort of market interference and yield curve interference had not been seen in the United States before. Japan had done similar things, with the central bank buying not only debt but also equities in the market. Note, of course, as we will see later, the Japanese stock market has never recovered from its highs. Other measurements the stock market is associated with would be indices of leading economic indicators. The idea of leading economic indicators is they can be predictors of whether you will have a recession or expansion in the future. Sometimes individuals try and use these to time the market. That doesn't work very well because the stock market itself is a leading economic indicator. This graph shows that the stock market goes up and down with the Economic Research Institute's leading economic indicator. Other institutes like the Conference Board and the American Institute for Economic Research also publish these sort of indicators. Not all market movements are associated with government printing money, and not all market bubbles are associated with government printing money. One of the most famous one in the past is tulip mania in the Netherlands in 1937. At this point in time, there was a huge bubble in tulips. This particular tulip, called the Viceroy, at the peak of this bubble, could buy all of these items here, including a lot of wheat, rye, oxen, swine, 1,000 pounds of cheese, a complete bed, a suit of clothes, and a silver drinking cup. These sort of manias occur over and over again, and they are discussed in detail in Charles Mackay, Memoirs of Extraordinary Popular Delusions and the Madness of Crowds, published in 1841. It is worth noting that the bursting of this bubble, as commonly happens, was associated with a recession in the Netherlands. Measuring bubbles, or at least investor sentiment, is used by people who try to time the market. Timing the market is very difficult, but if you do try to do it, things like put-call ratios are typically used. In other videos, we discuss options, puts, and calls. A call gives you the right to buy a stock for some set price and some set time. A put gives you the right to sell a stock for some set price and some set time. People buy calls when they are bullish, when they think the stock market will go up, because it gives them massive leverage. A 10% movement in the stock market might be able to double their money. People buy puts when they are scared. They are like portfolio insurance, and they insure the investor against market drops. The idea of contrary investment is if everybody else is bullish, you want to be bearish. If everybody is bearish, you want to be bullish. As Warren Buffett has said, you want to be greedy when others are fearful, and fearful when others are greedy. If we look at people buying puts, then they're going to be scared. So if a lot more people are buying puts than calls, then everyone is going to be scared. And this tends to be associated with market bottoms, like during the late time period of 1998 in October. You can see the put-call ratio was very high, around 70, and the market bottomed here and here. So this was a time period when everybody was scared, and it was good to buy into the market. On the other hand, during this time period, when everybody is bullish, everybody is buying stocks and buying calls, was associated with the peak of the market in 2000, and the dot-com crash followed. So it's hard to exactly pick out which time periods to use, but during this time period, people became more scared, and they were better times to buy, certainly, than during this time period. Another measurement of investor sentiment is the Investors' Intelligence Survey of investment advisors, and they call and ask, is the investment advisor bullish or bearish? They add up all the bullish investment advisors, divide by the bearish investment advisors. This is again considered a contrary indicator. If the investment advisors are bullish, they are telling all their clients to invest in the market. Presumably, if they are all bullish, then everybody is in the market. There's nobody else to come into the market, and they might change their mind later. So a high bull-bear ratio is considered a bad time to invest, a contrary indicator, which is shown on this graph with the green boxes, where you have high time periods of bullish-bearish sentiment and near market tops. The opposite down here would be bullish, when there are very few bulls in the market, lots of bears, and that's associated more likely with a market bottom. If everybody is scared, then everybody is already sold out, and they're going to change their mind and buy back in later on. When you invest in the stock market, particularly when you are young, it is a good idea to use tax-deferred accounts, putting off the taxation until a later date. This tends to lower your overall tax burden. The most common of these are 401ks, 403bs, and IRAs. If you work for a for-profit company, there is a pretty good chance they will have a 401k plan. And if you are under 50, you can put $18,500 a year of your own money into that account. Your employer may match some of that. If you are over 50, there's a catch-up provision, and you can put up to $24,500. If you work for a non-for-profit, a 403b largely operates the same way. Some companies will also allow you to invest in a 457 plan. The difference between a 401k and a 403b and a 457 is the 401k and 403b, the money is yours. The 457, the money is subject to the credit risk of the company. If the company or non-for-profit goes bankrupt, you could potentially lose the money in a 457 plan. If it's a 457 through a government, of course, this is far less likely. If you do not have one of these through your employer, you can invest in an IRA, but the investment limits are much less, $5,500, $6,500 with a catch-up provision. Roth IRAs are structured differently than these. These are all tax-deferred plans. With a Roth IRA, you pay the taxes now, but then presumably the money can be withdrawn later tax-free. All of these allow unlimited withdrawals after you turn 59 and a half, but if you withdraw money before that, you are subject to not only taxation, but a 10% tax penalty. Small business people also have access to plans down here at the bottom, the simple and SEP plans. The SEP plan, as noted, has a very high contribution limit. If you do save for retirement, the sooner you start, the better. This table shows a comparison of having 40 years to retire, say starting in your 20s, versus only having 30 years to retire starting in your 30s. It, of course, gets worse the longer you wait. This example uses the Texas Instruments BA2 Plus financial calculator. If you use that calculator and start saving tomorrow, then you would be in begin mode as opposed to end mode when you start saving at the end of the month. We are assuming a monthly payment. And our first example, you have 40 years times 12 months are 480 months. In our second example, you have 30 times 12 are 360 months. In both cases, we assume typical stock market rate of return of 8% beyond inflation, are 0.667% per month. In the financial calculator, you enter this as 0.666. If you were using Excel, you would use 0.06. In both cases, we are assuming you initially have no money and no debt, so PV is 0. I also have a video that has more details of this, giving examples of when you are in debt or when you already have investments in the bank. In both examples, we assume you want $1.5 million to retire. We enter these numbers into the calculator, we hit compute, and for the case of 40 years to retire, we only need to put $426 into the account, whereas if we only have 30 years, we need to put close to $1,000 into the account every month to be able to retire with $1.5 million. Note if this is a tax-deferred account, this money is taken out pre-tax, so the $400 is really $300 or less dollars each month, since the extra money would just go to pay taxes. This makes it very easy to retire wealthy if you start early enough. The U.S. stock market is, of course, not the only market you can invest in, and many of the world's other markets are cheaper than the United States. We noted the Shiller P/E, averaging earnings over 10 years due to past recessions, is very high at 30, while the forward P/E, estimating future earnings, in this example is only around 18. It's still high, but not nearly as bad for the U.S. But of course, other markets are much cheaper. the world average is 16, emerging markets are 12, and markets like Russia are down as low as 7. This indicates that diversifying in these markets could increase your performance and will certainly lower your risk. But note throughout this graph, markets do tend to go up together and down together, no matter where in the world you invest. Well, the U.S. stock market has always made money over a 30-year period, even after the Great Depression. This is not the case for all other markets. Japan, in particular, has done pretty poorly since its peak in 1990, and still, many years later, has not recovered that peak. For further reading, I list the American Institute for Economic Research's list of a market cycle indicators. I list my own video on time value of money and how to make similar calculations that we did in savings for retirement using Excel. The IRS's webpage has more details on all of the different types of retirement accounts. The Mises Institute has many discussions on Austrian business cycle theory. A good reference for more details about stock market performance is Wharton professor Jeremy Siegel's books, Stocks for the Long Run, and my favorite mutual fund, again, due to low fees and also not much trading creating capital gains, is Vanguard at vanguard.com. I thank you for watching this video.